Hello and welcome to Fireside with VC. My name is Andrew Romans, and we are today with Hadley Harris, who's a co-founder of ENIAC, which I believe he co-founded with his college buddies or MBA buddies. We'll get into that whole story. And these guys are, I guess, by today's standards, early in the New York ecosystem. We're going to talk about that whole evolution. Prolific seed investors. We've seen you guys on many cap tables, and we've got a couple stories of things happening between New York City and San Francisco and getting deals done quickly at the early stages. But Hadley, thanks for joining the podcast.
Thanks, Andrew. Thanks for having me.
Yeah. So I want to talk first. Well, first, maybe explain to us where you guys play, and then I want to get into the evolution of kind of the New York City venture ecosystem, and then also where we're at with the seed market since you guys have been so active and over such a long time.
Yeah, sure. So yeah, we're a seed fund. So we lead pre-seed and seed rounds. We've been investing since 2010. We're on our fifth fund at this point, and we've really been very consistent. Although seed has changed a lot in that time frame, what we've done hasn't. So we've been kind of focused on always our first investment being in seed. Now, seed has like lots of different variations between pre-seed, seed, and sometimes you have these kind of larger seeds, but always entering within that. And then we'll continue to invest in our companies kind of through Series A, B, and beyond. And we have a opportunity fund to keep investing over time, but those are following investments. We really focus on entering and leading those seed rounds.
Okay, so entry point would not be Series A, it would still be, and so
that's right.
I guess sometimes you guys are investing, as we've done, pre-company being formed, right? Like you're finding the company before they've incorporated or gotten the first employees, and then sometimes obviously much later. But maybe define the starting point to the end of the entry point for you guys.
Yeah, what you described is probably about as early as you can get. We've had a few cases where we've kind of known folks before and been involved and kind of verbally committed to the round even before the company is formed. I think from a legal perspective, you do need a company to invest in. So then, you go around and form the company and do those kinds of things. I'd say in most cases, more times than not, we are the first round. There are some cases where maybe a company has raised a small pre-seed round and then will lead like a $3-4 million seed round. But in most cases, it's the first round. And we pretty much are always investing before what I would consider kind of product market fit. I think once you kind of get through that and you get to scaling, there are a lot of great funds, multi-stage funds that are built for kind of scaling a company. We like to focus pre-product market fit. Just one reason is we think it's just the most exciting area. Like we love working closely with founders and kind of helping them get through that. And I think it is a kind of a somewhat of a skill that you pick up over time. Even though every company is different, you kind of learn things over investing in 12 years of what to look for. And the second thing is they're at the early stages when we invest, those companies tend to be very small. It's really the founders themselves and investing in the team versus kind of, there's not a lot of kind of finance involved. We all have entrepreneurial backgrounds. We're all engineering backgrounds, my partners and I. We've all built venture-backed companies. So I think that's just a better fit for our skill set. Whereas when you get into scaling and making those investments, a lot of times you have folks with kind of more of a financial background that are better at that.
So I remember, meeting Ron Conway a long time ago, and he pulled out a spreadsheet and showed 250 companies in one fund. And that seemed at the time very crazy to me. When you're investing in early stage, especially with other people's money, you tend to want to have a bigger set of companies to get enough diversification to neutralize the singular risk of investing in such early companies. Now you've gone over so many funds over, coming on 13 years. What do you think is the right number of pre-seed companies to have in a single vehicle fund to neutralize the risk in your mind? Or do you think about that completely differently?
No, we do think about that a lot. I don't think there's one answer to this. I think you can be successful with the Ron Conway model of doing a lot of investments. We actually somewhat opposite. We have pretty concentrated portfolios. So we do about 12 investments per year across the whole firm. And then we usually do a 3-year investment period. So we have about 36 investments per fund. When you're entering at pre-seed and seed, I think that's about as concentrated as you want to go. There maybe are a couple firms that will do a little bit less, but to your point, you need more shots on goal. You know, you need each investment to be a fund returner. Every one of our funds that is returned has a like one company that's returned the entire funds. That's just venture math. That's how kind of power law tends to work. And so you need enough shots on goal to feel like you have that opportunity. You can do more, but that's about as little as I would do if you're kind of entering it at pre-seed and seed.
Yeah. I mean, for me personally, I don't like to get more than one a month cadence, because then I feel like I don't even remember their names, or I'm not that value
Totally.
add. You know, I'm not that value add. Like I've heard other VCs say like, oh, I've got the options to invest in any one of my 1,500 companies. And I'm like, dude, you don't know what's going on with those companies. That's too many companies to keep track of. That's impossible to be their most valuable investor.
Yeah, there's no, I mean, like you can do that and you can do it successfully, but you're not kind of their main call, right? To your point. I mean, we do about 1 a quarter per partner. And I feel like, you know, we generally are leading those rounds. We're investing about half or more of that seed round. So we're kind of the investor of record, and you can do that with kind of, you know, 3-4 year per person. You could get up to 1 a month. That's probably about as high. But yeah, you start talking about some of these funds, and again, like that's their strategy to do 50 investments a year. It's just going to be a different type of relationship.
Yeah. I know like a buddy of mine works at Lightspeed as a GP, and he said it's like 2 investments a year, and there's 8 of us, you know, and
Yeah.
that it's a different, some personalities belong somewhere. Total
Yeah,
spray
totally.
to that. And the fact that you've got opportunity funds and follow-on funds forces you to keep track of them and hopefully be, you know, a value-added guy. So you're able to guide even in money, you know, afterwards.
Totally.
That's pretty cool.
Otherwise, you're not getting your allocation in the late stages.
Yeah. I mean, I always say there's the pro rata equity right to that they have to let you maintain your, you know, unless like some sharp elbow comes in, but then there's the earned pro rata, right? So talk about when I was an entrepreneur in the 90s, I remember I had a startup in Northern Virginia, Washington, D.C., where we basically flew over New York to get to Boston, where there was more money than in New York. And then as the .com craze raged in the late 90s, every investment banker took the tie off and got like a foosball table and had a VC fund somewhere in like Hell's Kitchen or something. And then they all disappeared after the .com, and they went back to their investment banking hedge funds. But so maybe describe how New York's VC ecosystem changed in the years that you've been there. So that would have been 2010 was
2010 is when we first. That's right. Yeah, it's changed a ton, you know. And I used to spend a lot of time out in the Valley, both as a founder pitching VCs, and even kind of the earlier days of pretty much up until COVID. The early days of New York, all the kind of opportunities you would see as an investor, and a lot of the folks that were building were there because it was New York. So it's like a lot of kind of fintech or selling into financial services. There was a lot of kind of fashion. There was a lot of ad tech. These were companies that kind of came out of the major industries of New York. And I think what you see now, and I think the data backs this up, is it just looks a lot more like the Bay Area. There's a little bit of everything. You have SaaS companies, you have infrastructure companies, you have these companies that traditionally you wouldn't have seen in New York as much. And it's just kind of much more well-rounded. The size of the ecosystem is much larger. If you look at kind of, depends how you define it, around kind of deals and money in, it's the clear kind of second largest market, and kind of growing quite a bit. So back then, to your point, a lot of folks in New York would kind of go up to Boston to go out to like 128 and pitch.
That's right.
VCs, and pretty much all of them are gone. Like there's a couple left, like Charles River Ventures, where I luckily was kind of get my start, that's kind of moved into the city. And
I think they like to be called CRV. Like they're not allowed to say Charles River. They're trying to get away from their Boston heritage.
They are close to Charles. Yeah, they are close to the river. Although, yeah, I think most are people out west. But yeah, it's funny. Yeah, so it's just changed a lot. It's gone from kind of like distant third market to like a clear second biggest market within the US. And then since COVID, I think you've kind of even seen it take off more in terms of more founders building kind of, again, like a diverse, like a broad array of things, and then more VCs moving out. Pretty much every large multi-stage fund is open an office. I get an email once a week for a office opening party. They all have much bigger offices than us and less people in New York, so it's always kind of funny. But yeah, it's great to see. I'm a big fan of kind of New York tech, and really nice to see what it's become. And the credit goes to like these founders that have built big companies. Especially the ones like kind of like a Mongo and a Datadog that you traditionally would only see in the Valley. Those are the ones that I think is most exciting versus some of like a bit more traditional areas.
How about the acquisition scene? I mean, it seems like a lot of the big balance sheet buyers, like the FANGs, are on the West Coast. I remember DoubleClick was a big New York acquisitive buyer for a little while, and then they got bought. But what's the acquisition scene like in New York? I mean, God knows there's no shortage of investment bankers in that city.
Yeah, that's not a problem. It's been kind of slow on the M&A front even the last year. Luckily compared to when we started, it was like all exits pretty much were acquisitions, and things have opened up at least until last year on the IPO front. So most of our larger companies are gunning for an IPO. We haven't really had a large acquisition in a while. Probably the last large one we had was, or sizable one was a PE shop. So I think overall M&A is kind of a global, at least kind of a nationwide thing. I don't know that there's that much kind of regional focus. All the FANGs do have offices in New York, so it's not like they can't buy a company and kind of have them work out of that office. So I'm not sure that I would say, other than the fact, as you said, that all the banks are generally headquartered in New York, that there's kind of a local scene.
Sure. So talk about how has seed investing changed over these years? Like, how are you pricing a seed round for a company what are the main building blocks of arriving at a cap on a convertible note or a valuation when the company's pre-product or pre-revenue, pre-product market fit? How do you guys think about that?
Yeah. Well, maybe just like at a high level, how things have changed over time. When we first started, for those first kind of 4 years, it was very unstructured. It was mostly party rounds. There weren't kind of clear leads. Most of the rounds were not were done on kind of convertible notes. And then I think the last, say, 5 to 7 years, it's become much more structured, where it is like a real asset class. You have a lot of funds like ourselves that focus on seed. You have multi-stage funds that also do seed. You usually have a lead investor. So it's slowly looking more and more like a Series A. There's still some differences. And then in terms of pricing over that time, it goes up and down a bit. I think generally prices have gone up over time as you've had more competition at seed, more funds. The number of seed funds has ballooned in that time. You also have the multi-stage funds that now do quite a bit of seed. I think it really kind of peaked in 2021 when pricing, honestly, I think just got out of control. And we were good about kind of sticking to our guns. So we didn't kind of go crazy doing, $50 million valuations, which just don't make sense at seed. I'm happy to kind of talk why that is. And now you've seen it kind of come back down. So I think we're back down to what you kind of normally would have seen, 4 years ago or so, where, what I'd call like a core seed round, so not a pre-seed. Often it's like a $2.5 million round. The median is probably like $10 or $12 million post. And that just kind of makes sense when you think about kind of the amount of equity that the founders are giving up, the amount of, as kind of larger seed firms like us, we can get our kind of 10% ownership. Maybe you have a co-lead that gets 10%, or maybe you have a bunch of smaller angels and funds that are getting kind of smaller amounts. It kind of works out for everyone. And that kind of got out of whack, honestly, in 2020, 2021, when you started having, these like 3 on, 40 post seed rounds. And it's just hard to build a business that way for folks like us.
Yeah, I mean, it's tough. I think it's a mistake. You want to price this round that you're doing now, wherever you are in your journey, so that the next round is not insanely mathematically unlikely to happen, right?
Totally.
So but talk about some specifics though, for people that wouldn't know this. I mean, how much money does a company raise in a seed round? Like, what's the size of the round, and what's the amount of share capital they're selling? So how much dilution, how much are all the investors combined going to get? And how
Yeah.
much should you be raising? Like, what would be like, you raise 500K from friends and families, 250K, then you raise a million, then you raise 2.5. What do those numbers look like, and how has that maybe shifted a little bit in modern times?
Yeah. I think like what you see with like a representative situation these days is, a pre-seed round could be like a million, million and a half, especially in kind of the larger markets, Bay Area, New York. Maybe it's 5, 6 post money. So let's call it 5 just for simplicity. Say they raise $1 million for simplicity. They're selling 20% of that company to all of the investors. That might be split between different investors. So say 2 split in half just for simplicity. They're each going to get 10%, and then that company would take a year, kind of get more traction. Build out the team. They're probably not getting through product market fit, but maybe they have some early customers. They have their product built. That first round could have been very early. And say they raise, I'm just, again, making up numbers, but what we normally see in the major markets, call it like 3 on a 12 post. So, again, all the investors together are buying 25% of that company. The new investors, by the way, get a little bit diluted, so they may want to participate in that round as well. And that's, again, that's doable from a kind of, so the founders are getting diluted 20%, and then their 80% is getting diluted by 25%, and there's probably an option pool as well for some of their employees. But those are round numbers. I think what you see in the major markets these days.
So roughly, you expect to get diluted by 20% when completing a seed or a late seed, even Series A. In ancient times, in the 90s when I was raising, you just double the size of the round, and that's your pre, because it was 33%. So it's like, you feel pretty confident with math. You're like, we're raising 5 on 10, meaning that the pre-money valuation is exactly double the size of the round, and that's your magic number of 33%. And then things kind of push towards more more competition, maybe, And
totally.
Then you don't want too much dead weight. Like, every VC says, oh, I'm not dead weight, I'm like a co-founder joining your team. But at some point you could argue that if you're not working at the company full-time, you're dead weight. And so I think there's always been that dilemma. Before you had seed funds, it was hard getting, where the hell are these angels? There was no list of angels, like Angel List,
totally,
to find them. Yep. So you could end up like, I didn't know any better, I had the wrong lawyer, and we started getting too diluted. And so by the time you meet benchmark Series A, and you needed a lot of money to get a website, even, that you might have had too much dead weight. So it's interesting to see the thing kind of get codified, and the dilution of like not so much in these rounds, moving forward.
Totally.
So what about the structure? So legally, it used to be you had a convertible note, was like a promissory note. And I didn't even realize until years later that I had raised money on an uncapped note, which I don't really generally invest on uncapped notes unless it's a very in between true bridge situation. But what percentage of the time are you investing in convertible notes or safe notes? And what percent of the time is it priced round?
Yeah, that changes by year, and part of it is kind of the level of power dynamics between investors and founders. But I think overall, say the last 5 years, it's probably been 25 to 35% notes, and the kind of 65 or whatnot on priced rounds. We generally prefer priced rounds when we're leading an investment of, the round of at least like 2.5 million. A lot of our kind of core seeds, which tend to be kind of 2.5 to 4 million, it makes sense to do a price round. For a kind of a pre-seed or a very small investment, that's when a safe probably makes more sense. They're cheaper, they're faster, and kind of done quickly. So the legal cost and time cost of doing a price round, which could be, for $30K or something, kind of all in for legal, and in maybe a month of your time, it becomes less kind of worthwhile when it's a small amount of money.
Yeah, I mean, like I think in general, you don't want to see a big percentage of the investment capital going out the door to lawyers, right?
Yes, totally.
That's bad. On the other
No one
hand,
likes that, except for the lawyers.
that's right. Well, and even the lawyers want to make sure that that company is getting funded, so they really get paid. But what are some reasons why you don't? Why would you prefer a priced round to a safe note? And if a founder wants to be make their financing attractive to ENIAC and investors like us, why should they be motivated to ever do a price round if the safe note was basically download, save as, it's in my back pocket, free?
Yeah, so when you do a price round, you coming out of that round, everyone knows exactly what they own. That's probably the biggest advantage, especially for founders. With you have safe notes, you can kind of keep raising different safe notes. A lot of them these days will be a post money safe. The calculations around how much you're getting diluted are actually pretty opaque, and it can be a real surprise down the road when you raise your Series A, and then all these safe notes will convert, and all of a sudden you're impacted a lot more than you think. So a lot of it is transparency. There is some kind of governance that goes along with price round. Often, but not always, you'll form a board. You may want the investor to be a board member. Our kind of approach is when we lead around, we will be the board member. We generally, but we don't have to be. We think that kind of governance at that stage isn't that useful. It's more about the relationship between us and the founders. Some founders, I think, will benefit from a board because they get used to that cadence because they're going to have one after the Series A anyways. A really kind of, for example, I invested a company called Tap Commerce, and we formed a board. I was a board member. I worked really closely with them. Those guys sold their company and started another company called Attentive, and they had already kind of done it all before. We didn't form a board. I didn't need to be a board member. I worked closely with Brian and team outside of the board concept. So it really depends kind of on the situation whether you need to form a board.
Yeah. And what about, we were talking about QSBS before we started recording this. I mean, how does QSBS, or what is QSBS, if you wanted to say quickly?
Yeah, sure. So I'm not a venture lawyer, but QSBS is Qualified Small Business. It basically allows earnings on qualified companies, which tend to be kind of startups under a certain value, to be tax-free. It's if you're a founder, you need to kind of get up to speed on this. It can allow a lot of your kind of when you eventually sell your company or you IPO or whatnot, a lot of that can be tax-free. There's like whole tricks you can do around like creating trusts and breaking up the trusts and sub-trusts. Probably too much for this, where you can actually, it's an advantage of investing in really early stage companies, and that's what it's supposed to do. It's supposed to spur innovation. So hopefully it's doing what it's supposed to do. But once the company gets to a certain level of maturity, I think it tends to be about $50 million in assets, it no longer qualifies. And there's a bunch of things you need to do to kind of qualify. But it's something if nothing else, you take from this, if you're a founder or early stage investor, like learn about it, make sure you're taking advantage, because it can really be helpful.
Yeah. I mean, the key point I would bring up is that if you invest on a convertible note or a safe note, pre or post money safe, a key thing is that the company's got to be under 50 million on the balance sheet, inclusive of that cash you're wiring. And you have to hold the stock for 5 years in a day. And so if we've been the patient guys that held the stock for 5 years in a day, our LP investors that are US taxpayers and us, it's zero tax on either the first 10 million or 10x your cost base. So if you put 3 million in and you made a gazillion on it, you pay zero tax on the first 30 million of gain. And the 5-year clock doesn't start ticking until that convertible note or safe has converted into equity. And so it's frustrating for me when I'm investing early that I see, okay, fine. If you're not investing on the safe, you're not playing the game. So we play the game and we invest in the safe. And then they're like, all right, now we're raising $15 million on a safe. And I'm like, guys, that's not going to start my 5-year clock ticking. And if you went that distance, I don't know. I just think it's this, I'd like to see a little more priced round discipline in this market, because it's better for a lot of people. But well, cool.
Totally. And we've definitely gotten hit with that, where, it's been 4.5 years, but it was a note, and then the clock didn't start till the A. So it's another advantage of price rounds for sure.
Yeah. I mean, if you ride out 12 years, like you have more than 12 years, you start to notice, ESOP got dropped on me. after the investment, and so I effectively, the denominator got bigger, my numerator stayed smaller, so I fractionally own less of this company than I thought. But it's hard to ignore the math when it's all happened. It's
Yep.
exciting going in. It's exciting going in. So let's switch gears and talk a little bit about technology, Hadley. What technologies, over Shakespearean timelessly have you been excited about with your kind of investment thesis, and what technologies are you excited about today? I know a lot of people are talking about generative AI is kind of, it's hard not to hear people talk about that, but what's exciting you guys right now?
Yeah, I mean, I'm fortunate that I've been involved with kind of AI-based companies for a while. One of the companies I helped build was Blingo, that was the first virtual assistant. So we weren't even allowed to call it AI because it was like a dirty word. This is back in 2006 through 2011, and then kind of one of my core, if not kind of the majority of my investments I've driven on behalf of ENIAC and as a firm have been kind of what I'd call like applied AI SaaS companies over the last 5 years. A lot of those were kind of NLU or natural language understanding based companies. So actually we made, and I was fortunate to kind of drive a few of these, like a bunch of generative AI investments last year and earlier this year, just because it was a natural evolution from NLU to understanding to generation. And as these kind of large language models have kind of been released and kind of shown what they can do, it's just gotten crazy, in my opinion, too hot in terms of money kind of and founders kind of rushing into this space. So I was mentioning this on Twitter, like the last 6 months, I'd say the average quality of the deals we're seeing within kind of applied AI has gone down quite a bit. And it's because there's so many founders rushing into the space. And like, I think that's great for the long term. The problem is when you meet a lot of these companies, it's clear they really haven't been thinking about this that long. It's like, in some cases they were working on like crypto a year ago, like crypto winter hit, all of a sudden the ChatGTP launched and they're like, well, I can apply this to this problem. I just think we're kind of too early for a lot of those founders. I think they're going to have, a lot of times I kind of encourage them to kind of keep thinking about what they're doing. It's probably another 6 months before they can apply it. It's just, what I would say is like a lot of what they're doing is a very thin layer on top of these existing kind of foundation models. And I worry that there's just not going to be enough value created on top of them. And when you ask them about how they kind of have these long-term moats, the answer is I think their understanding even of how like those platforms will develop, I think is unfortunately not right. So anyways, that's one of the space that we've been really excited about. Interestingly, like a little more bearish now that it's gotten so hot, because it's just like it doesn't seem like as much quality. But I am a believer kind of in AI in general, in kind of the combination of like understanding and generation being kind of completely fundamental to how things change going forward.
It's kind of ironic because we were in early. Well, I'm really good friends with a guy, Igor Jablokov, who founded Yap, which he sold to Alexa, to Amazon.
I know Igor as well. Yeah.
Okay. So Igor is was an LP.
Because they were competitors at Blingo, so we used to actually chat.
Yeah, so I get together with him all the time. He's a venture partner, LP in our fund, and he wanted me. I was invited to invest in the very beginning of Prion, but he was hiring people at like $1 million salaries, and he was just out there saying, "Hey, I'm Igor Jablokov. I'm going to hire anybody I want, and we could be valued at, we need to be valued at more than $1 million per engineer. I mean, I'm paying him $1 million a year." And so I was like, we don't have that kind of fund to do that. You know what I mean? But I'm always getting schooled by the guy. And then Kindy came along on the West Coast, right around the corner from me, when I was still living in San Francisco. And that was an NLP, like natural language processing company. And I just thought all the numbers just looked so much better to me. And I fell in love with Ryan too. So I kind of helping these two companies all the time, without, dancing too much in a conflict of interest. But the one thing I've learned is that this is almost like semiconductors. You can't just say like, oh, I'm going to hire my old roommate and just do this. It's like building some serious technology. So when the people that were fad seekers, they're just chasing whatever the flavor of the month buzzword is that they think the LPs want, the VCs want, and that they'll get. and they're putting their thin layer on this stuff, there's some serious stuff under the hood at both Kinder
Sure.
and Brian. So it's kind of ironic that it's attracting, yeah, I don't want to say anyone's a bad operator, but it's attracting the, flavor of the month, chasing that fad kind of person. So I feel it too. I remember like many, many years ago, in the same like month, I got 30 investment proposals out of Microsoft people around the second lifetime that the metaverse was going to be a really big deal. And that was,
Oh, the first metaverse. Yeah.
it was like 2006 or something. Like all of a sudden, everyone at Microsoft believed that Second Life, that we would all be, buying beachfront in Second Life as opposed to like on a beach. They
Yeah.
believed it so much that it just all came at once. So it was the ultimate. It was the first time I really experienced a trend happening like on my laptop, so viciously. But
Yeah.
so
People forget with this current ChatGPT thing that there was like a big chatbot craze like 5-6 years ago, where like a bunch of companies that are chatbot based got funded and really didn't go anywhere. And the reason for that is the underlying technology wasn't ready. But it's funny that a lot of people kind of have already forgotten about that kind of came and went. So there's a lot of cycles here I think people aren't really paying attention to.
you had a tweet that said like there was 1 and 2, and 2 is still the same, but 1 is not. What was
Yeah, that's right. Yeah, so the underlying, so there's kind of two reasons I think that the chatbot craze didn't work out. One was that the underlying technology wasn't quite ready, and I do think that is true. I think it's come a long way. It's like to your kind of semiconductor analogy. Like I think like NLU at least has been like beating Moore's law in terms of like how it's been evolving over that kind of 5-6 years. The other one was that chat interface is not right for a lot of use cases. And I think a lot of folks realize that in that, like, I don't know if you remember, but there was all these like bots where you could like update your CRM with a bot and you'd be like, okay, I have a new customer. And be like, what's the customer's name? And you would answer it. This sounds obvious now, but it would be like all this back and forth. Whereas like if you had a full GUI, you could just fill it in. And I think a lot of folks, I think, are getting a little confused because ChatGPT is using a chat interface for its own showcase, which is awesome, and it kind of shows the power of that. But then they build something on top of it, and they also have a chat interface, and it's like that's not the best use, like the interface for a lot of use cases. It's more likely that you might have like a GUI interface or whatnot that in the back end is communicating with that. So I think that's the one thing that will be kind of interesting to play out. Like, how does this chat interface kind of, where is it really useful? Something like search, yeah, I think it's really, really useful. A lot of other things like collecting information when you might want kind of more multimodal makes less sense.
I mean, I remember when I started my career, people talked about object-oriented software building and like object-oriented, like let's build with Lego bricks. And there was like RAD, I think rapid application development, RAD. And so like
I do remember that, yeah.
things like object-oriented, this whole concept of using Lego bricks, and then HTML was out before the web browser, so you could kind of upload an object of software and someone else could download it. It was as much of a miracle as the fax coming out in Geneva that was sent from New York. That now the idea that you can use like NLU, NLP that can understand like bank means riverbank, or do we mean Bank of America, and like starts to get closer and closer to accuracy. But at the level of like software, checking your code with generative AI, I mean, it is kind of exciting to see some of these things come together. But at the end of the day, you got to identify the right teams with the right business model, with the right verticalized attack. That will this interface be tolerated by a billionaire who flies private, or do we actually need to send a man in a van or something to handle the situation? But maybe the generative AI tells the person what to say quickly, right, while they're on that call. And so what are some other investment themes that you think you guys are going to be focused on for the rest of 2023?
Yeah, so we're generalists as a firm. I have a partner that spends a lot of time on fintech. I and another person do a decent amount of kind of healthcare, mostly kind of what I call modernizing the healthcare stack. Healthcare is weird, and then it's like very archaic, and sometimes it's archaic for a reason, sometimes it's not. So the hard thing is figuring out when it's there, when it's that way for a reason. Some often kind of clinical reasons. We do a decent amount of kind of SaaS, non kind of AI driven SaaS. I tend to focus on kind of SaaS built on top of some sort of AI. We also do kind of more run of the mill SaaS. So we're generalists. The only thing we tend not to do is things that are kind of very low technology, brand oriented investments, which you actually have a decent amount in New York. There was a lot of these kind of branded e-commerce companies, and we kind of steered clear of that. We never really understood, honestly, we never felt like we were able to judge them on what would be successful and how kind of the brand moat would evolve. I think we're fortunate that has done poorly, I think, over time. But other than that, we kind of touch everything within tech.
Okay, that's cool. And I mean, I know this, but for people listening, geographically, what are the core geographies that you focus on, or where do you stay away from?
Yeah, we're geographically agnostic. Especially since COVID, we used to require kind of the CEO be within North America. We have made some investments out where they've been in other areas. We have a ton of investments where often the CEO is in New York or the Bay Area, and a lot of the team is in India or Berlin or UK. It's just a great way to kind of arbitrage around kind of tech talent. So we're geographically agnostic. Our biggest hubs tend to be New York and San Francisco. We have 12 folks all in New York, so that's kind of our home base. SF and kind of Bay Area is still the biggest tech hub, and we have a lot of folks that we've kind of worked with there over the years. That's kind of number two. But yeah, we're not kind of focused from a geography point of view.
I think it was someone from ENIAC that asked me to meet with Doug Simpson at NAVD, because like you guys were ready to make an investment. You're like, I just wanted someone to see it and touch it. And so I met with him, and thanks to you guys, we invested in it, and we were pretty confident that we had that thing in the bag with the sale. But thank God for a little diversification. So that was one. That was one where I was like, I was the West Coast agent for the New York, guys.
Especially something like that with a physical component, you got to have someone meet them in person. So,
I had it in my car. I mean, I was using it myself. Like I had 2 NAVDs in my cars. I love that thing. I'm sorry it doesn't work anymore, but
I know.
Such is the game. Such is the game.
Yeah.
Well, really good. So parting to close out, let's talk about maybe what founders need to do to get through these next couple of, like, their next financing round or get to profitability, and where you see the exit market. I mean, obviously the multiples and the stock market have gone from what felt like normal to crazy to maybe below normal.
Yeah, I hope so. I mean, I hope this is below normal because they are definitely pretty depressed. Yeah, it depends on what stage they're at. But I think in general, I think at the very early stages, I think we're not that far away from normal. I think there's a lot of appetite for seed rounds, even for later stage investors. I think when you're looking more at the growth stages, it's really hard out there. And I think it's going to be hard to raise rounds. And those companies, we spent a lot of time with our kind of later stage investments, really trying to cut burn. We were lucky that a handful of them were able to raise money, usually at a flat round, which was kind of a big win at the time. But those are also companies that have been growing quickly. Ones that aren't growing quickly are not going to be able to do that. If you haven't kind of made adjustments at this point, I think unfortunately you're kind of in tough shape. Like last kind of like late spring was the time to really make adjustments. So I think it's actually a good investment. Ecosystem for early stage and later stage. To your point, the closer you can get to break even, the longer you can push off having a raise. I do think this year will be a bit of a bloodbath for growth stage companies that have to raise, and growth investors just seem like they're really slow and they're kind of waiting to get really good deals, because companies have to raise. So that's not the environment you want to be in.
Yeah. It's kind of a tough discrepancy between the bid ask of what founders are willing to do whatever it takes to keep payroll going. Their investors don't want to mark down a down round. New investors want some structure, which could really hurt guys like you and me if there's, a multiple liquidation preference comes in on a round that the company shouldn't be spending at, So I think, and then some of them are sitting here like, hey, I raised a huge round in the summer of 2021, and I'm, going to make that my runway is 19 years. And so I'm not going to get structured or taken advantage of from a late stage investor either. I have to make changes.
Yeah.
But I guess it's a tale of two cities, a little bit. If you can get to the point that you don't need money, then you'll negotiate a fair agreement to keep growing. Is what I think is what it's starting to look like where we're at right now with this evolution. Well, Hadley.
Yeah, I think you're right.
Well, that's great. So Hadley, you can be found on Twitter at Hadley, which shows you're the first Hadley on Twitter. You're not Hadley 266.
There was another one, but luckily props to my partner Nahal got Jack to give me that a number of years ago. So I'm one of the few guys that I don't deserve my own name on Twitter, but luckily got one.
Yeah, that's very cool. All right, man. Listen, I hope to see you soon in New York. Sorry you guys can't be at our event, but thanks for coming on the pod, and look forward to continuing to invest with you guys.
Sounds good. Thanks, Andrew. Have a good one.
Okay, you too. Thanks so much. Bye.